Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Anthony Woodside, senior solutions strategist at LGIM America, to discuss if it's premature to get constructive on corporate credit. Anthony, it's great to have you with us. Welcome to Trade Talks.
Great to be here, Jill.
Valuations in fixed income are certainly more attractive than the start of the year. Why do you think it's too early to get involved in corporate credit?
Yeah, Jill, valuations are certainly more attractive than it has been. If you look at corporate spreads, they're about 50 basis points wider on the year. However, we still see a proliferation of risks on the horizon. Of course, the geopolitical front, you'll see the tensions between Russia and Ukraine. And of course, when you look at some of the other components, particularly the Fed, that's the main driver for why we are pretty cautious here. We do expect the Fed to continue to hike here in spite of the fact that the economy is losing momentum. So we do think that it's pretty much important for investors to be a little bit careful here and maintain liquidity in their portfolios to deploy risks at better levels.
And back to economic momentum, while it certainly has slowed, what's your base case for the U.S. entering into a recession for 2022?
Sure. So when we look on the horizon, we do think that the U.S. is going to be able to avoid recession in 2022. We think that the U.S. consumer is in a strong position. If you look at the labor market is strong. If you look at just the cumulative levels of savings, the savings buffer that consumers have been able to accumulate, we think that that will allow them to be able to withstand through periods of elevated inflation. However, looking forward in 2023, we do see elevated risks for recession as the Fed tightening cycle starts to really bite consumers here.
And with the Fed continuing its hiking cycle throughout 2022, what's your outlook in terms of the terminal rate that we'll see and what that will look like for 2023?
Sure. So if you look at 2022, currently the market is pricing for an additional 175 basis points worth of tightening for the rest of 2022. So we're largely in agreement with that. So we think that the Fed is going to hike by 75 in July. We think they're going to hike by 50 basis points in September. And then in November and December, we think that they're going to hike 25 basis points apiece. Now, where we diverge from the market is the market expects the Fed to pretty much be done at the end of this year and actually start cutting in the second half of 2023. We do not agree with that assessment. We think that inflation is too elevated, too stubborn, too resilient here. So we expect the terminal rate to go as high as 4% in the first half of next year.
So, Anthony, do you think that we've reached peak credit quality as we're looking, we're going to be in earnings season in earnest in the next 2 weeks. And, it's really going to start to impact management decisions in terms of what they're doing with shareholder friendly capital management. If growth and earnings have peaked, what are your thoughts there?
So we would concede that we think that, peak credit quality has been reached. A couple of things informs this view. So if you look at earnings momentum, we expect earnings momentum to slow here. We had great earnings in the last year as we recovered from the pandemic here. But going forward, we think that there's going to be margin pressures here, given the elevated inflationary environment. And then secondly, of course, we have the Fed that's hiking as well. So we think that's going to weigh on growth going forward here. And we think that's going to translate into lower earnings. And lastly, on the credit quality front, we do see increased incidence of shareholder friendly behavior. And we think that that's going to weigh on credit quality as well going forward.
And finally, how are you positioning your portfolios?
Yeah, and so in our portfolios, we are pretty defensive. We're underweight credit right now. What we're focusing on is maintaining liquidity in our portfolios. What we're focusing on is rotating into more defensive sectors like pharmaceuticals, utilities, and non-cyclicals in general. And we do think it's imperative to move up in credit quality as well. If you look in periods of stress and periods of slowing growth, what you generally see is a decompression within credit, where lower quality cohorts of the credit markets tend to underperform the higher quality cohorts. So we're rotating out of triple Bs, generic triple Bs, into higher single A quality type names.
All right, Anthony, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you.